Usually when we talk about something like a medical diagnosis, there's an expectation of, absolute precision.
Oh, right. Like an engineering level certainty.
Exactly. I mean,
Yeah.
you fall down, your arm hurts, the doctor pulls up an X-ray,
Mhm.
and there is just this jagged white line on the screen. It's completely binary. The bone is broken or the bone is intact.
Yeah, and it's a comforting dynamic, honestly. We really crave that kind of visible, objective categorization.
We do, because it makes the chaos of life feel suddenly manageable. Like there is a definitive right answer.
Right. But step out of the hospital and into the world of corporate finance, and that X-ray machine is just, it's completely shattered.
Oh, totally.
Yeah.
You're suddenly trying to look at a future that hasn't even happened yet and somehow put a definitive to the penny price tag on it.
Which is mathematically terrifying if you think about it.
It really is. So today we are opening up the black box of how the modern world actually values tomorrow. This is a deep dive into a foundational text in the industry.
Yeah, we are looking at the third edition of Financial Modeling by Simon Benninga.
Right. And this book is this dense, incredibly comprehensive look at how high-level financial theory gets translated into practical, everyday spreadsheet models.
And what becomes apparent very quickly when you read it is that those massive spreadsheets, the ones with rows and columns of perfectly formatted numbers, they project this powerful illusion of mathematical certainty.
They absolutely do. You look at a complex discounted cash flow model, and it feels like looking at that X-ray.
It feels safe.
Yeah, because the math running through those cells is perfectly objective. I mean, 2 plus 2 will always equal 4.
Right, but what's fascinating here is that while the architecture is pure science, the inputs feeding that math, the growth rates, the risk
And
assumptions,
the human element.
exactly, those require a staggering amount of human intuition, judgment, and frankly, storytelling. The math is objective, but the inputs are pure art.
Which is exactly why we were unpacking this today. The goal of this deep dive isn't to turn you into, like, a human calculator.
No, definitely not.
It's to shortcut your path to actually understanding the philosophical engines running Wall Street and corporate boardrooms right now.
Because whether you're prepping for a major capital allocation meeting or, just trying to make sense of your own retirement portfolio.
Or if you're just intensely curious about how a multinational conglomerate decides a new acquisition is worth exactly $2.4 billion.
Right. You need this toolkit.
You do. To me, financial modeling is basically a time machine.
Oh, I like that.
Yeah. It's a mechanism that takes all the swirling, chaotic uncertainty of what might happen next year or 10 years from now and distills it into one concrete number in today's dollars.
That time machine analogy is spot on. You are essentially reaching into the future and pulling capital back into the present.
Right.
But to operate that machine without blowing it up, you have to understand the fundamental laws of financial physics.
Okay, what is the absolute bedrock law then?
The gravity that holds the entire system together is the time value of money. You literally cannot value a company or a new factory or a stock without first establishing how you value time itself.
Let's start right there, at the foundational level of this time travel. We're talking about present value and net present value.
Exactly. And the core concept here is opportunity cost.
Right, so opportunity cost is basically the benchmark return that you require to make any investment viable compared to what else you could be doing with your capital.
Yeah, because a dollar today is lazy if you don't put it to work.
I mean, if I have a crisp $100 bill in my hand right now, it is inherently objectively worth more to me than a $100 bill you promised to give me a year from now.
Because you could be earning interest on it. Opportunity cost is just a formal way of measuring what you're giving up.
Let's ground this in a really straightforward scenario. Imagine someone pitches you an investment.
Okay.
They promise to hand you exactly $100 at the end of every year for the next 5 years.
And we know they're good for it.
Yeah, with absolute certainty, they're good for it.
Right.
There is zero risk of them defaulting. But you aren't forced to buy this contract. You have alternatives.
Right, because you always have alternatives.
Exactly.
Yeah.
Let's say your local bank is offering a guaranteed 10% annual interest rate on a 5-year deposit.
Okay, so that 10% is your hurdle.
Yes.
It is your opportunity cost. It's the alternate reality you are giving up if you choose the guy's $100 a year pitch.
Right, because if I pass on his pitch, I can just walk down the street, hand my cash to the bank, and effortlessly ride that 10% compounding wave.
So whatever this guy is selling you has to at least match that 10% reality.
Exactly. And to figure out if it does, I have to take my time machine and pull each of those future $100 payments backward to today.
And you penalize them by that 10% rate for every year you have to wait.
So how does that math actually work?
The mechanics of that penalty are just basic division. You take the future cash flow and divide it by 1 plus your interest rate, compounded for the number of years.
So to find the present value of that very first $100 coming a year from now.
You divide 100 by 1.10.
Okay, so that tells us that the first payment is worth roughly $90.90 today.
Exactly. And the payment coming in year 2 is penalized twice.
Because you're waiting 2 years.
Right, so you divide it by 1.10 squared.
Okay, so that second $100 bill is only worth about $82 today.
Yeah, and the further out you go, the more the value decays.
So year 3 drops to about $75. Year 4 is $68.
And by the time you get to that final payment in year 5, that $100 is only worth about $62 today.
Wow. Just because I missed out on 5 full years of earning 10% at the bank.
Exactly. Now, if you sum up the decayed value of all 5 of those payments, you get a total present value of roughly $379.
So that is the exact mathematical worth of that future stream of cash to you right now, today, given your specific opportunity cost.
That's your baseline.
So if the guy pitching me this investment says, I'll sell you this 5-year contract for $250.
You would be out of your mind not to take it.
Right. I am essentially buying $379 of intrinsic value for just $250.
And you just arrived at net present value.
Oh.
NPV is simply the present value of the future cash flows minus the initial cost you paid to get them.
In this case, $379 of value minus the $250 cost.
Which leaves you with a net present value of about $129.
I just instantaneously increased my wealth by that amount in today's terms.
You essentially found a glitch in the pricing matrix.
Right. Now, what usually surprises people is that in a perfectly competitive, frictionless financial market, the net present value of an investment should technically be exactly 0.
Yes. That trips a lot of people up.
That always breaks my brain a little bit. I mean, why would a massive corporation deploy millions of dollars into a new project if the NPV is 0? It sounds like they're working for free.
Well, because an NTV of 0 does not mean you made 0 profit.
It doesn't.
No, it means the investment yielded exactly your required opportunity cost.
Oh, I see.
In your scenario, it means you earned exactly your 10% hurdle rate. If the true mathematical value of the cash stream is $379, in a perfectly efficient market, the seller wouldn't be foolish enough to offer it for $250.
Right. They would demand exactly $379.
Exactly. The price would perfectly reflect the value. So finding an NPV greater than 0 implies you found a bargain.
A market inefficiency.
Right.
But we know the real world is messy. Markets are not perfectly efficient. People find bargains, and CEOs regularly overpay for acquisitions.
Oh, constantly. Resulting in massive wealth-destroying negative NPVs.
And to calculate all this, literally the entire global financial system relies on one specific tool.
Microsoft Excel.
Yeah. It is the undisputed heavyweight champion of financial software. Millions of analysts fire it up every morning to run these exact NPV calculations.
But Beninga's text points out a flaw in the software that is, frankly, terrifying.
Okay, let's unpack this. What's the flaw?
Excel's built-in NPV function is fundamentally misnamed. It does not actually calculate net present value.
Okay, what?
It is one of the greatest traps in modern corporate finance, and it has caught countless junior analysts and probably more than a few senior partners who just haven't looked under the hood of the software in a while.
So what does it actually calculate?
Well, by definition, standard financial terminology dictates that net present value must include the initial cash outflow.
The cost of the asset at time 0.
Right. It is the net difference between the upfront cost and the future benefits. But Excel's NPV function entirely ignores time 0.
It ignores today.
Yes. It only calculates the present value of the future cash flows, and it assumes that the very first cell you highlight in your formula occurs at the end of period 1.
Okay, let me visualize this, because the real-world implications seem huge.
They are.
Imagine a spreadsheet. In cell A1, I have my time 0 cost, let's say a negative $250 million to build a new factory.
Okay.
Then, in cells A2 through A6, I have the positive cash flows the factory will generate over the next 5 years.
Standard setup.
Right. So if I'm an overworked analyst at 2 a.m. and I type equals NEPV, put in my discount rate, and just click and drag my mouse over the whole column, A1 through A6.
You will generate a mathematically catastrophic answer.
Oh no, why?
Because Excel's algorithm will assume that your initial investment of negative $250 million isn't happening today. It assumes it's happening a year from now.
Oh wow, so it discounts the initial cost.
Yes, it discounts the cost of the factory. Then it treats your year one profits as happening in year two, and your year two profits as year three.
So every single cash flow in that multi-million-dollar model will be discounted by one period too many.
Exactly. To get the true net present value in standard finance terms using Excel, you have to run the NPV function strictly on the future cash flows.
Just cells A2 through A6.
Right. You close the parenthesis, and then you manually add the negative times zero cash flow from cell A1 entirely outside of the formula.
That is wild. Why in the world would Microsoft, building a universally accepted software, get a fundamental finance term so wrong?
It's baffling.
I mean, just think of the butterfly effect of that. How many billions of dollars in capital have been misallocated? Or how many deals were scrapped because someone dragged their cursor over the whole column and inadvertently tanked the valuation of a project?
The sheer volume of capital mispriced by that naming convention over the last 30 years is unknowable, but it is certainly a massive number.
So where did this quirk even come from?
It likely comes down to the difference between software engineers and financial theorists.
Oh, interesting.
Yeah. Early Microsoft programmers were likely thinking about arrays and sequential data strings. They built a logic that made sense for feeding data arrays into a loop, but they completely ignored the chronological reality of how cash actually leaves a bank account at time zero.
And Benninga points out this isn't an isolated quirk.
No, not at all. The same logic framework causes Excel to return negative values for positive cash flows in other standard functions, like the present value or payment functions.
Wait, really? A positive cash flow shows up as a negative?
Yeah, the software treats it like a double-entry accounting ledger. If money comes into your pocket, it's technically a liability to the internal system, so the software slaps a negative sign on it.
That is so counterintuitive. And if you're just trusting the machine, it's a disaster waiting to happen.
Which underscores the most vital lesson for anyone doing this kind of work. Critical thinking cannot be outsourced to an algorithm.
Yeah.
A modeler has to understand the why of the mathematics. You cannot just blindly trust a software function because it has a comforting, familiar name printed on the tin.
You have to look under the hood.
Exactly. If you don't understand the chronological mechanics the engine is actually executing behind the scenes, you aren't doing financial analysis. You are just pressing buttons and hoping for the best.
It's like relying on a GPS that confidently tells you to turn right into a lake.
Right.
At some point, you have to look out the windshield and verify reality.
Exactly.
So now that we understand how to value finite cash flows and, avoid driving our spreadsheets into a lake, we need to tackle a much bigger conceptual problem.
Okay, let's hear it.
A 5-year contract is easy. But what happens when you are valuing something like a massive blue-chip corporation? Because they don't plan on closing shop after 5 years. What happens when the cash flows go on forever?
That transitions us into the realm of annuities.
Annuities.
Technically, an annuity is just a security that pays a constant sum in each period. Your 5-year, $100 contract earlier, that was a finite annuity.
Got it.
But in corporate valuation, we are usually dealing with infinite annuities or perpetuities.
Because companies don't have expiration dates.
Right. We operate on the going concern assumption. It's the idea that a business will continue to exist and generate cash indefinitely into the future.
But the human brain really struggles with infinity.
It does.
I mean, it feels like the math should just explode. If I get paid $1,000 a year forever, the value should be infinite, right?
You would think so. But paradoxically, dealing with infinity actually makes the formulas incredibly simple.
Really?
It's one of the most elegant paradoxes in finance. Because of the gravity of the time value of money, those payments stretching out decades and centuries into the future decay to essentially zero.
Oh, because they get discounted so many times.
Exactly. They are so heavily discounted they lose all their weight. Because of this, the infinite sum converges on a very clean, finite number.
Give me an example.
So if you have an investment paying a constant $1,000 every single year forever, and your opportunity cost is 12%, you don't need a complex multi-year spreadsheet.
What do?
The formula collapses to a single division problem. You just divide the cash flow by the discount rate.
That's it?
That's it. $1,000 divided by 12%.
Okay, so 1,000 divided by 0.12. Let me think. That gives you roughly $8,300.
Yep. That is the entire value.
A literal eternity of $1,000 checks discounted at 12% is only worth about $8,300 today.
Exactly. It's totally clean. But we have to add a layer of realism because healthy businesses don't just pay a flat, stagnant amount forever.
Right, because of inflation.
Well, you're right.
A stagnant cash flow loses purchasing power.
Exactly. Healthy businesses grow. So we adjust the math for a growing infinite annuity.
Okay, how did that work?
Let's say that $1,000 payment grows by 6% every single year into eternity.
Okay.
The formula elegantly adapts. It becomes the cash flow divided by the difference between the discount rate and the growth rate.
The discount rate minus the growth rate.
Yes. So 12% minus 6%, which leaves us with 6%.
So now we take that initial $1,000 and divide it by 0.06.
Right.
Which jumps the present value up to roughly $16,600.
Look at that.
Just by baking in a 6% annual growth rate, the present value of that infinite stream literally doubles. It goes from $8,000 to $16,000.
It's powerful.
I always picture this as the ultimate golden goose. I mean, an infinite annuity is a golden goose that lays an egg every year forever.
Right.
But a growing infinite annuity is a golden goose that lays a slightly larger golden egg every single year for the rest of time.
I love that. And if we connect this to the bigger picture, that golden goose is the conceptual anchor for modern equity markets.
Really?
Yes. When an analyst at a major investment bank is trying to put a price target on a Fortune 500 company, they are essentially treating that corporation as a golden goose laying ever larger eggs.
Wow.
This specific formula cash flow divided by discount rate minus growth rate is the mathematical engine running the Gordon Dividend Model, which we'll tear apart later in this discussion.
You know, these formulas feel so baked into the modern stock market. It's like they were born on a Wall Street trading floor in the 1980s.
Right.
Did some quantitative analyst just invent this during a boom market?
You'd think so, but they actually predate the modern stock market by centuries.
Wait, really?
This is one of my absolute favorite historical detours in all of finance. The Gordon model and these infinite annuity formulas are direct descendants of a geometric series formula created by Leonhard Euler.
Euler.
Yes, Euler was an 18th century Swiss mathematician.
It's the 1700s.
He was solving abstract theoretical math problems with a quill pen long before anyone conceived of a decentralized global equity market.
That is insane.
Yet his work on infinite geometric series, which you probably suffered through in high school algebra and immediately forgot, is the literal bedrock of modern capitalism.
It is wild to think that the same algebra Euler was sketching out in the 1700s is currently pricing trillion-dollar tech conglomerates.
It just proves how universal these mechanical laws are.
It really does. But let's flip the perspective for a second.
Okay.
Up until now, we've been using a known discount rate to figure out the value in dollars. The net present value.
Right.
What if we know the cost of the project and we know the future cash flows, but we want to figure out the percentage return it's actually generating?
Then you are looking for the internal rate of return, or IRR.
IRR.
If NPV is the total miles you've traveled, the absolute wealth you've created in dollars, IRR, is the speedometer.
Oh, that's a good way to put it.
It tells you how fast your wealth is compounding in percentage terms. Technically speaking, the IRR is defined as the exact specific discount rate that forces the net present value of an investment to perfectly equal zero.
It's the break-in rate.
Exactly.
To really visualize how this speedometer works, the text uses a brilliant tool, an amortization loan table.
Yes, the loan table is fantastic for this.
Imagine you invest $800 today. Over the next 5 years, it pays you back varying amounts. Let's say $200 in year 1, $250 in year 2, scaling up to $400 in year 5.
Okay.
If you plug that stream into a financial calculator, it spits out an IRR of roughly 22%.
Right.
But what is that 22% actually doing under the surface? The loan table proves it by splitting every single cash flow you receive into 2 distinct buckets.
Your true income and the return of your original principal.
Exactly.
It is a beautiful way to demystify the math, because in year 1, you receive $200.
Right.
But that entire $200 isn't profit.
It's not.
Your true income for that year is your beginning principal. The $800 you have at risk multiplied by that IRR of 22%.
Okay, so 800 times 22% is roughly $177.
Yes. That is the actual interest wealth you generated.
Which means The leftover $23 from that payment is just the project handing you back a tiny slice of your original investment.
Exactly. So entering year 2, you don't have $800 at risk anymore,
I have 800 minus 23.
which leaves you with a new principal balance of $777.
And then the cycle just repeats.
Right. In year 2, your income is 22% of that new lower principal balance of $777.
So the interest goes down, and the remaining portion of your year 2 payment pays down the principal even further.
Yes. And if you run this iterative process all the way to the final payment in year 5, the income perfectly matches the interest owed, and the remainder of the final payment exactly wipes out the principal balance to 0.
Not a penny more, not a penny less.
That is the defining characteristic of the internal rate of return. It is the exact compounding rate that perfectly amortizes the invested capital to 0 over the life of the project.
It looks so clean and perfect when you lay it out in a table. But unlike net present value, where you just crunch a straightforward division formula, you can't just algebraically solve for IRR.
Right.
There's
Yeah.
no clean formula where you plug in the cash flows and the rate just pops out.
No, because solving for a rate across multiple different time periods requires calculating the roots of a high-degree polynomial equation.
A polynomial equation.
You can't just isolate the variable. It requires a process of trial and error. You have to guess a rate, run the whole NPV calculation, see how far off from 0 you are, guess a different weight, and repeat.
So Excel's built-in IRR function is just automating that iterative guessing game at lightning speed.
Exactly.
Here's where it gets really interesting, though.
Yeah.
Because it's a polynomial equation, Benninga highlights a phenomenon that completely shatters the illusion that IRR is a foolproof metric.
Oh, this is the best part.
A single investment project with one fixed set of cash flows can actually have multiple internal rates of return.
Yes.
How does a single project yield 2 totally different mathematically correct speedometers?
It drives finance students insane because it feels like a trick question. But it comes down to the shape of the cash flows and something called Descartes' rule of signs.
Okay, break that down for us.
Most standard business projects have a single sign change. You have a negative cash flow on day 1 when you make the investment, followed by a string of positive cash flows as the project makes money.
Right, negative to positive.
One sign change means one unique IRR. But what if the project has negative cash flows at the start, positive cash flows in the middle, and then a massive negative cash flow at the very end?
What kind of business actually operates like that, where you literally bleed money at the end?
Extractive industries are the classic example. Think of a major mining operation or an offshore oil rig.
No.
You spend hundreds of millions up front to drill the well. That's a massive negative cash flow.
Right.
Then, for a decade, you pump out oil and generate incredible positive cash flows. But when the well runs dry, you can't just walk away.
Because of environmental law.
Exactly. By law, you are required to spend tens of millions of dollars to cap the well, dismantle the rig, and perform environmental remediation.
So that creates a massive negative cash flow at the end of the project's life.
Negative, positive, negative, 2 sign changes.
Which means the math allows for 2 positive roots.
Yes.
If you were to graph the net present value of an oil well like that across a whole spectrum of different discount rates, the line wouldn't just cross the 0 axis once.
Right.
It would swoop down, cross into positive NPV territory, and then, as the discount rates get extremely high, the math forces the curve to swoop back down and cross the 0 axis a second time.
And since IRR is defined as the rate where NPV is exactly 0, everywhere that line crosses the axis is technically an IRR.
That is wild. The textbook models a scenario exactly like this. The cash flows are negative up front, positive for a few years, and heavily negative in year 5.
And if you type the Excel IRR function and give it an initial guess of 10%, the algorithm latches onto the first root it finds.
And it confidently tells you the IRR is around 9%.
But if you take the exact same function with the exact same data and just change your initial guess to 50%.
The algorithm finds the other root and spits out an IRR of nearly 27%.
And both numbers are mathematically flawless. They both force the NTV to 0.
So if I'm the CFO, which number do I present to the board? Do I tell them the new mine yields 9% or 27%?
You don't tell them either.
Really?
Because in a multiple IRR scenario, the metric itself has economically collapsed. It is utterly meaningless.
How so?
You cannot rationally claim wealth is compounding at 27% if it is simultaneously compounding at 9%.
Right, that makes no sense.
If a modeler blindly relies on IRR without checking the shape of the cash flows or looking at the absolute NPV profile, they are flying blind. They might approve a terrible project or kill a great one just because Excel grabbed the wrong root of a polynomial equation.
It is the ultimate proof that math is a tool, not a substitute for comprehensive judgment. You know, it is so easy to sit here and judge corporate executives for getting this math wrong or, blindly trusting a software output.
Oh, totally.
But the truth is, this exact same mathematical illusion, this failure to intuitively grasp exponential growth, traps millions of everyday people in their own lives.
It really does.
We've been talking about corporate boardrooms, but let's look at how our own linear brains betray us when we try to apply these formulas to personal finance and retirement.
The time value of money does not care if you are a multi-billion-dollar conglomerate or a school teacher trying to save for the future. The mechanics are identical.
Right.
But the problem is human evolution. We are biologically wired to think linearly. If I walk 2 miles an hour for 3 hours, I go 6 miles. It's simple arithmetic.
But when we apply that linear, back-of-the-napkin arithmetic to money over long periods of time, the results are catastrophically wrong.
Benninga refers to this specific cognitive blind spot as the retirement trap.
Let's walk through the psychology of this trap. The book uses the scenario of a 55-year-old who wants to retire at age 60.
Okay.
They have a 5-year window left to aggressively save, and they plan to make 5 annual deposits into a retirement account.
And what's their goal?
Once they hit 60, their plan is to withdraw $30,000 a year for 8 years to fund their lifestyle.
Okay.
So if that 55-year-old sits down at their kitchen table with a calculator, how does their linear brain try to solve the problem?
The flawed logic unfolds exactly like this. They say, I need $30,000 a year and I need it for 8 years.
Right.
8 times 30 is 240. So my ultimate goal is a pile of cash worth $240,000.
Seems logical so far.
I have 5 years left to build that pile. 240,000 divided by 5 is 48,000. Therefore, I must deposit $48,000 every single year for the 5 years.
To a human brain, that sequence of logic feels perfectly rational. It feels safe.
It sounds completely airtight, but it completely ignores the entire concept of compounding.
Right. If we actually model that out, assuming their retirement account earns a standard 8% interest rate, the reality diverges wildly from their kitchen table math.
Because if you save 48 grand a year, that money isn't just sitting in a vault, it is actively compounding at 8%.
By the end of year 5, you haven't accumulated $240,000. Thanks to the interest, your pile is actually over $304,000.
And the blind spot gets even worse during the withdrawal phase.
Oh.
When they start taking out their 30 grand a year, they assume the pile just drains linearly. But the remaining balance inside the account is still compounding at 8%.
Oh, right, because it's still invested.
Exactly. The interest generated on a $300,000 balance is massive. If you withdraw 30 grand a year for 8 years under those conditions, you don't end up at zero.
Where do you end up?
You end up with a surplus of over $218,000 sitting in the account at the end of year 8.
They overshot their goal by $250,000.
Yes.
To find the actual true annual deposit required, you have to throw away the arithmetic and use present value formulas.
You do.
You have to discount the 8 years of $30,000 withdrawals backward in time to year 5 to find the lump sum needed, and then solve for the 5-year payment required to build that specific lump sum.
And you can do this elegantly with Excel's solver tool, balancing the entire timeline to zero.
Right. And when you do the proper math, the required annual deposit isn't $48,000.
What is it?
It is just over $29,000.
That is nearly a $19,000 difference in required annual savings.
Every single year.
And this is why financial modeling isn't just a Wall Street exercise. It is a life planning necessity. When people use linear math, they essentially ignore the contribution of compound interest.
You know, I always think of compound interest as a silent business partner.
A silent partner, yeah.
This partner doesn't sleep, doesn't take vacations, and works 24/7 to add money to your account. If you plan your life pretending this partner doesn't exist, you are going to make wildly inaccurate, life-altering decisions.
Absolutely.
That 55-year-old might choose to work a miserable, high-stress job for 5 extra years because they believe they have to save 48 grand, when in reality, 29 grand would have gotten them exactly to the finish line.
Modeling forces us to acknowledge the silent partner. It forces us out of our flawed intuition and anchors us to reality.
Oh, exactly.
Now, up until this point, we have been talking about discrete compounding. You earn 8% a year, and the interest is applied once at the very end of the year.
Right. Chunky math.
But the mathematics of time value can be sliced much thinner, and when you start slicing time, you approach the edge of infinity.
This is the concept of compounding intervals.
Yes.
If I put $1,000 in the bank at 5% annual interest, simple math says I have $1,050 on December 31st. The 5% was applied in one single chunk.
But what if the bank decides to apply the interest semi-annually?
So they give me 2.5% in June and another 2.5% in December.
Exactly. Because that first interest payment in June is reinvested, it actually generates its own tiny bit of interest during the second half of the year.
So you are earning interest on your interest faster.
Right. So instead of $1,050 flat, you end up with $1,050.62.
I generated an extra 62 cents simply because the compounding interval was more frequent.
Now, the natural mathematical question is, what happens if we push that frequency to the absolute limit?
Okay.
What if the bank compounds your interest every month, or every day, or every single millisecond?
Well, if I am compounding every millisecond, earning interest on the interest millions of times a day, does the math just break? Does the balance explode into infinity?
It does not. And this is where calculus steps in to provide a beautifully elegant boundary. Calculus. As the number of compounding periods approaches infinity, the total growth curve flattens out. It converges on a very specific, immovable mathematical limit, and that limit is defined by Euler's number.
The Swiss mathematician strikes again. We literally cannot escape Leonhard Euler in this deep dive.
He is the architect of the entire system. Euler's number, represented by the letter E, is an irrational constant, roughly 2.718.
Okay.
In discrete math, your future value is the principal times 1 plus the rate. But in continuous compounding, the formula fundamentally shifts.
How so?
It becomes the principal multiplied by E raised to the power of the interest rate multiplied by time.
Okay, so let's use the $1,000 again.
So an initial $1,000 growing at 5%, continuously compounded every nanosecond for a year, doesn't reach infinity. It hits an absolute mathematical ceiling of exactly $1,051.27.
Wait, that's it?
That's it. You can compound it 1 trillion times a second, and you will never earn a fraction of a penny more than that limit.
It is an incredible mathematical parlor trick. But let's be real. I have never walked into a retail bank and seen a brochure for a continuously compounded checking account. They deal in days and months.
True.
So outside of a university calculus exam, why does anyone in finance actually care about us?
Well, retail banks don't use it, but continuous compounding is the central nervous system of high-level institutional quantitative finance.
Really?
If you are a macro hedge fund modeling a massive dynamic portfolio, continuous returns are mathematically cleaner to work with. But more profoundly, continuous compounding is the core assumption underlying the pricing of financial derivatives.
Oh.
The famous Black-Scholes model, which literally birthed the modern multi-trillion-dollar options market, requires the assumption of continuous compounding and continuous time. The entire derivatives market, the mechanism institutions use to hedge global risk, is built on the back of E.
So the algorithms trading millions of option contracts in milliseconds are all running Euler's constant.
Absolutely. And on a more practical level for everyday modelers, assuming continuous compounding solves the nightmare of messy, real-world timelines.
Messy timelines.
Yeah. Let's say you invest in a private business and it grows from $1,000 to $1,500, but it takes exactly 1 year, 7 months, and 12 days.
Oh, I see. Calculating an annualized return using discrete, chunky math on an uneven timeline like that is incredibly cumbersome.
It's awful, but if you assume continuous compounding, you simply take the natural logarithm, the ln function in Excel of the ending value divided by the beginning value and divide it by the exact time period.
Oh, wow.
It is an incredibly fast, mathematically elegant way to standardize messy data into comparable annualized rates.
Okay, we have thoroughly mapped the mechanics of the time machine.
Yeah.
We understand opportunity cost. We've navigated the traps of multiple IRR IRRs, and we've pushed compounding to its absolute continuous limit.
We've covered a lot.
But now we have to face the dragon. We know how to discount a cash flow, but when we zoom out and try to value an entire, complex living corporation, what discount rate do we actually use?
Now we are crossing the bridge from pure objective mathematics into the highly subjective realm of financial theory.
It gets murky.
Very. The discount rate that values an entire firm is known as the weighted average cost of capital, or WACC.
WACC. It sounds ridiculous, but it is the singular metric that dictates whether a corporation grows or shrinks.
It is the ultimate benchmark. The WACC serves as the overarching hurdle rate for the entire enterprise. It is the blended average of what it costs the company to source its capital.
Right.
If a CEO wants to launch a new product line, build a factory, or acquire a rival, the projected return of that specific project must clear the WACC.
So if your blended cost of capital is 10% and your shiny new project only yields an 8% return, you are actively destroying the value of your own company.
Even if the accounting department says the project is turning a profit.
Exactly. I always visualize WACC as that painted wooden sign at the entrance of an amusement park roller coaster.
The height requirement.
Yeah. The cartoon character holding out his hand saying, "You must be this tall to ride." For a corporation, WACC is that sign. If a proposed project's return isn't tall enough, it doesn't get past the capital allocation committee, doesn't get to ride.
That is exactly how capital allocation works in a healthy firm. The complexity lies in calculating the exact height of that sign.
Right, because capital comes from different places.
Exactly. The WACC formula blends two distinct sources of capital, the cost of equity and the cost of debt. These two costs are weighted by their proportional size in the company's capital structure.
So if a firm is funded by 60% stock and 40% bonds, those are your weights.
Yes, but there's a crucial nuance. You must adjust the cost of debt downward to account for corporate taxes.
Wait, why does debt get a special tax adjustment, but equity doesn't?
It comes down to how tax codes are written globally. Interest payments made to bondholders or banks are classified as tax-deductible business expenses.
But dividends paid to shareholders are not.
Right. Therefore, the government is essentially subsidizing the company's decision to borrow money. This creates a tax shield.
So if the bank charges you 10% interest, but your corporate tax rate is 30%, your true after-tax cost of that debt is actually only 7%.
Exactly.
Okay, so finding that cost of debt seems incredibly straightforward. The company has a loan, the interest rate is written on a piece of paper, and you adjust it for the tax rate. The market is screaming the cost of debt right at you.
Yes, debt is easy.
But equity. Finding the cost of equity feels like trying to nail Jell-O to a wall.
It really does.
Shareholders don't have a legally binding contract guaranteeing them a specific return. They are at the absolute bottom of the capital structure, taking all the residual risk. So how do we figure out what return millions of anonymous investors are silently demanding to hold the stock?
It is the most difficult subjective challenge in valuation. You have to mathematically reverse engineer the minds of the investors.
Which sounds impossible.
It's close. You observe the current stock price, observe the company's financial output, and deduce the return that must be expected to justify that price.
Right.
And tackling this monumental challenge led to the creation of the two great theoretical frameworks of modern finance, the Gordon Dividend Model and the Capital Asset Pricing Model.
Let's start with the Gordon Dividend Model. Philosophically, it connects perfectly back to the growing infinite annuities we discussed earlier.
It does.
The Gordon model argues that the fundamental intrinsic value of a share of stock is nothing more than the present value of all its future anticipated dividends stretched out to infinity.
It is a beautifully pure philosophy. It treats a stock exactly like that golden goose we talked about.
So what's the formula?
The simplified algebraic formula states that the current stock price equals the expected dividend for next year, divided by the required cost of equity minus the expected growth rate of the dividends.
Price equals dividend divided by R minus G.
Exactly. And if you know the price and you know the dividend, you can easily rearrange that algebra to solve for the unknown variable, which is R, the cost of equity.
So, solving for R, it equals the dividend yield plus the growth rate. Let's look at how Benninga applies this to a real-world scenario using Kellogg.
An example.
Back in 2006, Kellogg's stock was trading at $48.28. Their annualized dividend was $1.11. The price and the current dividend are hard, observable facts.
But that growth variable is a projection. It requires an analyst to make a subjective judgment about the future.
And that subjectivity is where the model becomes incredibly fragile.
Completely fragile. The text shows that if you base your growth assumption on Kellogg's most recent 5-year history, the growth rate was 1.9%.
So you plug that in, and the Gordon model says Kellogg's cost of equity is roughly 4.2%.
But if you zoom out and look at their 10-year historical growth, the rate was 3.6%. Using that assumption, the cost of equity jumps to a flat 6%.
That is a massive swing.
Huge.
I mean, a hurdle rate of 4% leads a management team to greenlight entirely different projects than a hurdle rate of 6%. The entire strategic direction of the corporation hinges on whether the analyst chose to look at 5 years of data or 10 years of data.
Yes. But the textbook highlights a much more insidious trap when relying on the Gordon model.
What's that?
Dividends alone are rarely an honest reflection of how a modern company manages its equity capital. If you just look at the dividend payout, you are often modeling a complete fiction.
Because companies do other things with their cash.
Exactly. To find the true cost of equity, you have to measure total equity cash flows.
This is where the Johnson & Johnson case study in the book is so illuminating.
Oh, it's a great case study.
If you pull up a chart of J&J's standard dividends per share throughout the late 90s and early 2000s, it is a masterpiece of corporate stability. It is a smooth, predictable, gently upward sloping curve. It looks incredibly safe.
But corporate management teams are acutely aware that institutional investors pay a premium for smooth, predictable dividends. Wall Street hates volatility.
Right. They want a smooth ride.
So management teams will do almost anything to keep that dividend line perfectly stable. They will hide the true chaotic volatility of their underlying cash flows by using other, less obvious mechanisms.
Like stock buybacks.
Primarily, yes. They use massive stock repurchase programs to flush out excess cash in highly profitable years, and they issue stock often through employee stock options to conserve cash in tighter years.
Benega points out a staggering reality. Stock repurchases now account for roughly half of all the cash disbursed by U.S. firms.
Half. If your valuation model only looks at dividends, you are literally ignoring half of the money moving between the company and its owners.
The raw data on J&J is shocking when you peel back the curtain. The dividend payout is rock steady. But in a single year, around 2002, their stock repurchases exploded from under $3 billion to over $6.5 billion.
And simultaneously, they were issuing hundreds of millions in new stock to employees.
So when the modeler stripped away the dividend dilution and aggregated all of those total equity cash flows, dividends plus repurchases minus stock issues, the actual growth rate of cash moving to shareholders was vastly higher and vastly more erratic.
And the mathematical consequence of that volatility is profound. When you input the true total cash flow growth rate into the Gordon model, J&J's required return shatters the illusion of a safe, sleepy blue chip stock.
What did it jump to?
Their calculated cost of equity rocketed to roughly 19.5%.
Wow, 19.5%. It just exposes how the smooth dividend is a carefully managed corporate veneer.
It is.
But beyond the corporate manipulation of payouts, the Gordon model has a fatal structural flaw. The denominator of the formula is the discount rate minus the growth rate. What happens when a company is growing so aggressively that its growth rate actually exceeds the discount rate?
You hit the mathematical boundary condition of the model.
Right. If a booming tech firm or an aggressive bank has a growth rate of 20%, but the discount rate is only 15%, the denominator becomes a negative number.
The formula breaks and spits out a negative stock price.
And if the growth and discount rates are exactly equal, you are dividing by zero, which implies the stock has infinite value.
Both of which are logical impossibilities in a finite economic universe. It exposes the core limitation of a single-stage model.
You just can't assume that kind of growth lasts forever.
You cannot mathematically extrapolate supernormal explosive growth out to infinity, because eventually the laws of capitalism dictate that massive profits will attract vicious competition, markets will saturate, and growth will cool down.
So to fix the time machine, we have to add gears. We need a model that can shift its assumptions over time.
Exactly. We deploy the two-stage Gordon model, sometimes called the supernormal growth model. It is a much more nuanced framework.
How does it work?
We allow the model to assume that the company will grow at a blistering supernormal rate for a defined short-term period, that's stage 1.
Okay.
But we force the model to acknowledge economic gravity. We assume that after a few years, that growth will inevitably decay into a normal, sustainable macroeconomic growth rate that lasts forever. That's stage 2.
The book uses Wachovia Bank as the perfect test subject for this.
Yes, Wachovia in the late 90s.
In the late 90s, Wachovia's equity payouts were compounding at an astronomical 28% per year.
Which is unsustainable.
Totally. If an analyst blindly shoved 28% into the basic single-stage Gordon formula and assumed it would last until the end of time, the math completely short-circuits.
Right. It calculates a required cost of equity of over 37%.
There is no bank on the planet that has a baseline hurdle rate of 37%. The number is absurd.
This raises an important question, though. How do you model that reality? Because it is entirely divorced from reality. So we impose the two-stage framework to tame the math.
Okay, so we allow Wachovia to enjoy that 28% supernormal growth for just 3 more years.
Right. Then we abruptly drop the growth rate down to a conservative long-term macroeconomic average of 4% for the rest of eternity.
And when you calculate the complex net present value of those 2 distinct stages and solve for the internal rate of return, the required cost of equity instantly normalizes.
What does it drop to?
It plummets from the impossible 37% down to a highly realistic 17%.
Exactly. It's a perfect example of why modelers must constrain raw math with rational economic narratives.
But even with 2 stages, the Gordon framework is completely useless for a massive portion of the modern economy.
Oh, yeah.
I mean, how do you use a dividend model on a company like Amazon, which famously refused to return cash to shareholders for decades, opting to reinvest every single penny back into the business?
You can't. If there are no cash flows to discount, the Gordon model has nothing to analyze.
This structural limitation is why modern corporate finance largely shifted its reliance to a totally different paradigm. The capital asset pricing model, or CAPM.
CAPM abandons the internal mechanics of the company entirely. It doesn't care about dividends, repurchases, or internal growth projections.
It looks outside the company.
Right. It approaches valuation from a purely external macroeconomic perspective. CAPM derives the cost of equity by analyzing the statistical relationship between the individual stock's price movements and the movements of the entire broader stock market.
The entire philosophy rests on the distinction between systematic risk and idiosyncratic risk.
Exactly.
I think the easiest way to visualize the core metric of CAPM, which is beta, is to imagine a massive bungee cord.
A bungee cord, I love this.
Picture the overall stock market, the S&P 500, as a heavyweight moving up and down. Now imagine an individual stock is attached to that market weight by a bungee cord.
Okay.
If the cord is thick and stiff, the stock is pulled along in near-perfect lockstep with the market. But if the cord is thin and super stretchy, the stock bounces aggressively, experiencing much wilder, exaggerated swings relative to the market's movement.
And beta is simply a mathematical measurement of how stretchy that cord is.
Exactly.
The bungee cord is a fantastic analogy for systematic risk. Let's examine Benninga's breakdown of Intel to see how this is calculated.
All right, what do they do?
The textbook runs a statistical linear regression, comparing Intel's monthly stock returns against the S&P 500's returns over a 5-year period.
Okay.
The slope of that regression line is the beta. For Intel, the regression output calculates a beta of 2.25.
Meaning Intel's bungee cord is extremely stretchy. Historically, for every 1% the S&P 500 moved, Intel stock moved 2.25% in the same direction.
Yes, it amplifies the macroeconomic tide. It is highly leveraged to the overall sentiment of the market.
But beta is only a piece of the regression story. The output also gives us an R-squared value, which tells us how reliable that bungee cord analogy actually is.
Right, and Intel's R-squared was roughly 0.53.
Now, if you take a math test and score a 53%, you failed. It implies the model only explains half the story.
Yeah, if the engineer building my time machine says they are only 53% confident we will land in the correct decade, I am not stepping into the machine.
Exactly.
It sounds inadequate, but in the realm of financial statistics, an R-squared of 53% is actually considered quite robust.
Really? Why?
What it means is that 53% of the total chaotic variance in Intel's stock price is driven entirely by macroeconomic, market-wide forces, inflation, interest rates, global GDP. That is the systematic risk. The remaining 47% of the variance is purely idiosyncratic to Intel. It is driven by internal factors. A brilliant new chip architecture, a supply chain bottleneck, or a change in the executive suite.
And here is the philosophical genius of CAPM. The market absolutely refuses to compensate investors for taking on that 47% of idiosyncratic risk.
Because you don't have to take it.
Right? Because a rational investor can instantly eliminate that specific risk for free simply by diversifying. If you own Intel alongside 50 other totally unrelated stocks, Intel's specific supply chain problem is canceled out by another company's specific success.
The specific quirks average out to zero.
Therefore, you are only mathematically rewarded for bearing the 53% systematic risk, the market-wide risk that cannot be diversified away.
And beta is the exact measurement of that specific unavoidable risk. You only get paid for the risk you are forced to hold.
That makes perfect sense.
The regression also yields one more fascinating data point, alpha.
Oh, right, alpha.
Alpha is the intercept of the line, and it measures the stock's independent performance, completely divorced from the market's movement. In this dataset, Intel generated a negative alpha.
So it suggests that holding the overall market constant, Intel fundamentally underperformed.
Yeah. So does that mean the executive team at Intel was objectively destroying shareholder value during those 5 years?
Well, you might assume that.
You might, but this is where statistical literacy is paramount. You have to look at the statistical significance of that negative alpha, specifically the t-statistic.
And what did it say?
For Intel, the t-statistic was incredibly close to zero. In statistics, a number that small tells the modeler that the measured underperformance is not statistically significant. It is essentially indistinguishable from random noise.
So the math cannot confidently declare that Intel's management failed. It only proves that stock prices are inherently noisy. Okay, so bringing it all back to the CAPM formula. We take Intel's beta of 2.25. We combine it with the risk-free rate, say the yield on a guaranteed government bond at 4.9%. We factor in the expected return of the overall stock market, around 9.8%.
And you plug all of that into the equation.
Right. And it calculates Intel's cost of equity at roughly 16.3%. That is the hurdle rate dictated by external market risk.
But as Benninga points out, financial theory is always evolving. There is a final, highly debated twist to this calculation. The tax-adjusted security market line, proposed by Benninga and Oded Serrig.
A tax adjustment for CAPM.
Yes. The original CAPM framework was drafted by academics in the 1960s, and it assumes a mathematically pure world devoid of corporate taxes.
But as we discussed earlier with the WACC, corporate taxes are a massive, distorting reality that heavily subsidizes debt over equity.
Right. The tax shield makes debt artificially cheaper.
Precisely. Benninga argues that to be theoretically rigorous, the CAPM formula should acknowledge this differential tax treatment.
By adjusting the risk-free rate component.
Exactly. By adjusting the risk-free rate component of the CAPM formula to reflect the corporate tax rate, multiplying the risk-free rate by 1 minus the tax rate, the model becomes structurally pure.
And when you apply this tax adjustment to Intel, assuming a standard corporate tax rate, the impact is startling.
What happens?
Intel's calculated cost of equity shifts upward from a 16.3% to a full 18%.
Wow, that is nearly a 2% increase in the overarching hurdle rate, generated entirely by a theoretical tweak to the formula's purity.
And massive.
That 2% could easily be the difference between Intel deciding to break ground on a multi-billion-dollar semiconductor fabrication plant or completely scrapping the project.
And this exposes the ultimate tension in financial modeling, the conflict between theoretical purity and practical utility.
Yeah.
Yes, the tax-adjusted model is theoretically superior, but look at the inputs. We are guessing the future expected return of the stock market. We're assuming a 5-year historical beta will perfectly predict the next 5 years of volatility.
The inputs are inherently fuzzy.
Extremely. Many seasoned practitioners argue that layering complex tax adjustments onto highly uncertain estimates creates a dangerous illusion of precision.
Because if your guess regarding the overall market return is off by even 1%, the sophisticated tax adjustment is totally swallowed by the error.
Right. Sometimes a simpler, slightly flawed model is actually safer than a hyper-complex one that tricks you into absolute confidence.
That feels like the perfect summation of this entire deep dive.
It really does.
We have covered an incredible landscape today. We started in the weeds, manually fixing Microsoft Excel's fundamentally flawed MPD function to ensure we weren't discounting our time-zero investments and driving our models off a cliff.
An important lesson.
We explored the beautiful, elegant mathematics of infinite annuities, tracing the architecture of modern capitalism all the way back to Leonhard Euler's 18th century algebra. We confronted the terrifying reality of the retirement trap, recognizing how our biologically linear brains consistently fail to grasp the exponential power of our silent business partner, compound interest.
A literal lifesaver.
We pushed compounding intervals to the absolute brink of infinity to discover the mechanics of E that run the global derivatives market. We wrestled with the mathematical collapse of supernormal growth, using Wachovia to prove that models must be constrained by economic reality.
Then we measured the stretchiness of Intel's bungee cord.
Yes, using CAPM regressions to extract a cost of capital from the chaotic noise of the broader market.
It is a profound, incredibly powerful toolkit. These are the mathematical lenses through which capital is steered across the global economy. They shape the infrastructure we build, the technologies that get funded, and ultimately the future we inhabit.
But I want to leave you with one final, provocative thought.
Okay.
A philosophical challenge that builds directly on the foundation we just laid. Both the Gordon Dividend Model and the capital asset pricing model rely profoundly, fundamentally, on historical data.
They do.
They mandate that we look backward in order to see forward. They depend on past dividend growth trends, past stock price regressions to find beta, past market risk premiums. But what happens to the integrity of these elegant models when the future becomes fundamentally disconnected from the past?
Ooh.
If an unprecedented paradigm-shifting event occurs, a sudden global technological singularity like artificial general intelligence, a catastrophic climate shift, or even just a massive company completely reinventing its core business model overnight, do these rigorous, peer-reviewed equations just become highly sophisticated illusions?
That is a scary thought.
If our financial time machines are constructed entirely from the scrap metal of yesterday, can they ever truly price the uncertainties of tomorrow?
That is the ultimate vulnerability of the discipline. We are driving at breakneck speed into an unknown future, and our navigational instruments require us to stare fixedly in the rearview mirror.
Something to mull over the next time you open a spreadsheet and see those perfectly aligned rows and columns. Keep questioning the models, and we will catch you next time.